is up, guys? Welcome back to another episode. Today, we're going to try to simplify as much as possible in a short amount of time how to trade the ICT concepts on indices. This can be used for Forex, futures, commodities, etc. So here we have the 15-minute time frame. Okay. So things we're going to be looking for is number one, we're going to be looking at areas of buy side or sell side liquidity. This is going to be in the form of relatively equal highs or relatively equal lows, as well as gaps in the market that we call fair value gaps. Others call it imbalances. These are called PD arrays, or targets that the market will magnet to because they're areas of liquidity. Now, why does the market want to go to these areas? Because these are areas that people's trailing stop losses are at, or limit orders are at. So they're areas that there's a lot of liquidity resting that the smart money or the institutional order flow likes to go to grab liquidity. This is equal to sell side to grab liquidity. Now, that's the first thing we're going to be looking for. Okay. You also want to try to think about your daily bias or the trend, right? Where's the market sentiment going? Meaning, which direction is the market more likely to go to? This can be determined by the trend. Also, like when you look for these equal highs or equal lows, wherever the market is at, is it closer to that equal high, or is it closer to those equal lows? Where would it be easier for it to take out first and reverse from? So you want to see at where are you currently at? Are you closer to buy side or are you closer to sell side liquidity? So that can help also on your daily bias. Okay. So that we want to know where's our, and this can change. It can be, you have to be adaptable, adapt to the markets, right? Don't predict. Don't try to predict, but react. Be adaptable. Your sentiment can kind of change. Don't get too caught up or confused, but it can change. Okay. So, daily bias, you can use top-down analysis from the daily time frame to the 1 hour down to the 15-minute for direction. Okay. So we go to the daily. We can see that we have been in this. We had been in this downtrend, right? They were high, low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, equal lows. Okay. Now we had market has been making this push up recently, and now we're creating equal highs here. Okay, so what has it been doing with this pullback, right? What can you see that the market's been doing is we're starting to break structure here, right? So we broke this high, pulled back down, then we broke this high here, and now we broke this high here. So essentially market structure has shifted temporarily to bullish, right? So clear these out. Now if you look from this last blue candle to this bearish candle before we started this move up, if we were to run our GAN box from the high to the low of this wick of this candle, this is your range. This is how you figure out your range on your daily time frame. So you can see market moved from a premium, a high price, to a discount, low price. Now we've come back up over the equilibrium, or the middle part, the middle area, and we're back heading into a premium. Now, what do you want to do when things are at a high price? If you have a car that's worth a lot of money, you want to sell it in a good high price, for a good high price in the high price market, right? If price was in a discount, right, and you're looking to take buys when things are at a good price, right? If you have a car that's discounted, you want to get it at a good price, buy it and sell it up here, right? Makes sense. Buy low, sell high. So now that market has moved into a premium or over premium, we're looking for where it could possibly tap into, or if we continue up, right? So if you see now, we have what we talked about is finding those equal highs and equal lows, right? So this is relatively, it doesn't have to be perfect, equal highs, and now we also have equal lows down here, right? Now, like we said, to predict where is the market more likely or closer to take out liquidity or those equal highs, where is it more likely to take out? Is it more likely that it's going to take out these lows down all the way down here, or is it more likely that the market's going to take out these equal highs, right? The answer is these equal highs up here, because we're closer in relative current price to this area. Now, when we're looking at arrays or points of interest, we want to look at equal highs or equal lows, fair value gaps or imbalances, right? So since we have identified equal highs here that we're close to, what are some other points of interest that we have listed up here that we're close to? If you look here, you have a gap from this bullish wick here to this wick here, right? You have these three candles, and in between there is a imbalance of price. During this whole run, only sell opportunities or sell side was offered. There was no buy side offered in this candle, right? It was nothing but sells in here, right? No buys in here. So the market needs to come up and offer this gap as a buy candle, meaning one, we have equal highs, the market will take out liquidity, and we also have an imbalanced market that the market needs to come up and rebalance and reprice in order to make its next, whatever it's going to do next, if it's going to go higher or if it's going to go lower. So that being said, now we have two areas of confluence that the market is more than likely going to run up into, meaning what is our bias or our analysis of where the price is going to go to? It's going to be bullish, right? So that's how you would come up with your daily bias. Now, clear this out. Since we're bullish, right? Since we're bullish, we would come down to the 15-minute time frame. And so let me grab this. Grab this text here. Here. 15. Okay. So that's how you would come up with your areas of interest. Now, this can be used in two different instances. What we have up here, typed out here. It works on what's it called? External, right? Or otherwise known as higher time frame. Liquidity. Right? So that's right, that's external liquidity is what we just did on the daily chart is what we just did, right? Now this can also be used, and you also use it for internal liquidity, okay? Meaning internal liquidity or the lower time frame liquidity, okay? So this is considered like, your traditional top-down analysis. Okay, so what we did on the daily was the higher time frame to get our direction, right? So knowing that, we know we're bullish, right? Okay, now you do the same thing on the 15-minute time frame. The same thing we just kind of did on the smaller time frame. Okay. What's awesome is about the next part is we have this theory that it's not really a theory, but concepts and principles the ICT teaches about time and price theory. Okay, so this is what I love about this is there's specific times and prices. So it's like we were waiting for a bus. You know that the bus is going to come between a certain time of the day. So if you're there to catch the bus, you're going to catch the bus at that time. So that's a quick little what's it called metaphor. So moving forward, we know that our New York hill zone times, okay, kill zone, yep, New York kill zone time. That is going to be back on 7 a.m. to I like to say noon, 12 a.m. Okay, New York time. Now, how do you know it's New York time? When you come down here to your settings of your time, have it set to New York. That way it takes out all the confusion. UTC -4 in New York, right? So now all the times on here are the same times as New York time, and you just try to figure out, the time difference between wherever you're at in the world compared to New York. Okay. So 7 a.m. to 12 a.m. is our New York kill zone. Now, to get even more precise, you have certain times that the market and volume comes in heavy to the market. So you have 7 a.m. is like the start of New York session or New York Stock Exchange. 8:30 a.m. okay, is a key time because the stock exchange opens, right? So the stock exchange open, okay? Then you have 9:30 a.m. The commodities in the Chicago Commodities Exchange opens. So CME open, okay, 9:30 a.m. New York time. And then you have 10 a.m., which is another key time of volume because this is when the news embargo this, meaning anything having to do with news, CPI, non-farm payroll, Fed speech, stuff like that. Usually always happens after 10 a.m. or around 10 a.m. for news, impact news. Okay, medium to high impact news. What's that going to bring? That's going to bring more volume and volatility to the market. Okay. Okay. So these are our key times. So knowing that, right, let's simplify that some more. Okay. So coming into our 15-minute time frame. Okay. We're going to come back on Friday, which was it's Wednesday, Friday. Okay. Friday. Bear with me. Let's turn this on here. Now, I have a really cool indicator that I forget who put me onto it, but I found it on someone else that uses concepts. ICT index futures. Okay. Now it's really cool because it sets all the vertical lines for you for the New York Times that we just talked about. Okay. So as you can see, right in here. Now I'm going to hide this for a second just so I can, for teaching purposes, but that's one of the indicators that will help you out moving forward. So I'm just going to write some vertical lines here. So we have our 7 a.m. open. Then you have the second time is 8:30. We have 9:30. And then you have 10. Okay. The reason why I say noon on the kill zone time above, what I wrote above, is because about 11:30 noon, that's when New York lunch, right? People go on lunch until about 1:30, be 13:30. Okay, this is your no trade zone. Okay, so that's the time we don't want to be trading. Okay, so now that we have our times delineated here on the 15-minute chart, we're going to hit replay mode about 8:30. Okay, so prior to 8:30, okay, so we're going to type this out. Prior to 8:30 a.m., we're going to be looking for relative equal highs or lows to be taken out. Okay. Why are we looking for those to be taken out first? Okay, because we're bullish equals equal lows to be taken, because we want to buy, cannot type, just bear with me guys, because we want to buy low, right? Buy at a discount. So we're looking for lows to be taken. We want price to get down to a discount to cheaper prices so that we can buy it at a really good price and it move up on us, right? Okay, so we're bullish. We're looking for equal lows to be taken first. Prior to 8:30, we're looking at where is there equal lows or a swing low to be taken. Okay, So sometimes it's not easy. You have to zoom out like this, okay? So as you can see, we're gonna make a line where price is at. Do we have any equal lows? Sometimes this takes some practice. You have this swing low, right? These lows, this down here, here. So I would say this swing is relatively close. See how it's not going to be perfect. As you see to the left, it doesn't really touch too close, but over here you're touching. So if we look, that swing low is already taken, right? So now we know, okay, the swing low, the equal lows have been taken. Now we're getting ready to look for our possible buy entry signal setups. Okay, so step one of this on the 15-minute time frame is prior to 8:30. We're looking for equal highs or lows. Since we're bullish from external liquidity, we're looking for internal liquidity, which is these equal lows to be taken. Prior to 8:30, we have these equal lows. This were already taken before the open, just before the open, right? So now what are we waiting for next? The next step now is, I don't know where to put this stuff. There we go. So our next step now is we are going to drop down to the, we're gonna stay here for now. So because you really want to trade between 9:30 and 10. For me, that has been the highest percentage of win rate. You can catch moves 8:30 to 9:30, but typically around 9:30, 10, even a little bit after 10 is when I found the best setups running into the lunch no trade time. So our next step is we're going to be looking and waiting for a market structure shift in the direction that our bias is, which is bullish. Okay. Now, how do we find that market structure shift? It's going to be a swing, in this instance, a swing high. Okay. If we were bearish, we would be looking for a swing low. Okay. So the next step is we're looking for market structure shift. What is a swing high? What is considered a swing high? Right. This is sometimes can be hard to figure out. Get rid of this. Okay. So a swing high is 3 candles. You'll have one candle with a high. The middle candle has a higher high, and then the third candle has a lower high than the middle candle. You see that? High, higher high, lower high. Let me see if I can draw this. I'm not the best with the paintbrush tool. Okay. See this arch here. Those 3 candles. See that swing high? Okay. That is what we're waiting for market to be broken on the 15-minute as a swing high. Now, if it was a swing low, we're looking for the opposite, right? And if you look here, you have an example right here too. Okay, you look at right where market took out the sell side or the equal lows, relative equal lows here. You have these 3 candles here. You have a low, then the middle candle has a lower low, and the third candle has a higher low. So now you have, this would be considered a swing low. Okay, so that would be your swing low, swing high. But for this case, we're looking for the swing high to be broken as a market structure shift. Okay. Now, inside of the market structure shift, okay, see here, when the shift happens, it will create an imbalance or a fair value gap. Okay. There's going to be so much volume coming in that's going to break that structure that it will create that gap moving the other direction. Okay. So we move price forward here. You see, boom, look at that huge candle look up, right? What to do? It breaks this high. Right there, it breaks the swing high. That is your market structure shift. Okay. Your market structure shift. Okay. This is your sell side liquidity being taken. Then you have your market structure shift. Boom. Right. We move price forward. Now, like I said, what happens when the shift when the shift happens, it will create an imbalance or a fair value gap, right? And what does that do? You see here from this wick, this bottom of this wick, this up here, the bottom of this wick here to the top of this wick here. What happened? There's a gap in price or an imbalance, right? Only buy side was offered here. That's it. There's no sell side being offered price here. Price was only offered on buy side, meaning the market has to come back to rebalance, right? So what I do is I will take a box here and draw my box just like this from that wick to this wick, right? So we have this box priced in. Let me change the outline to black. Okay. Now this is our $15-minute fair value gap. Okay. Now we're still waiting for that for 9:30, 10:30 for our entries, right? So now that we have this being set up, we're going to drop down to the 5-minute and see if we can kind of refine this a little bit more. As you can see, the gap was more here, okay, to there. We also have a gap here to here, okay. Now what you want to do, this is a 5-minute gap. 5-minute VG. Okay. At this point, what you want to start doing is working your way down from the 15-minute to the 5. I like to go to the 2 and start refining these gaps in the market. Okay. You can see it's still kind of the same. But if you wanted to, clean it up, you can. But you want this is where it comes down to you as a trader. What is going to be more towards your personality? What is your appetite risk? For me, it seems like the 5-minute chart looks a little cleaner. A little smoother here. Now, what you could do here is you would want to actually when you have this market structure break at 9, be dropping down to these lower time frames. And now I'm constantly switching back and forth. So you can, so you're not, in case you miss these shifts and these gaps, you want to be kind of bouncing up and down in real time as the market's coming and making your analysis in real time. Okay, so this is now our 5-minute gap. So what you do is you'd be waiting for price to come back and return into this gap here. Let me get rid of this line now. Okay. Into this gap for your entry. Okay. Now, if you were to enter on here at the top of this box, you have to know that market could also come all the way down and tap into this lower gap here. So as for good position, or what's the word I'm looking for risk sake, you'd want to put your stops below this. You can put it below this wick here or below this lower swing low. I would put it below this lower swing low here on this candle. Keep it tight. Right, so that's your entry that we're waiting for it to come back to. Now you can set a pending order if you want, or do market execution. I like to wait for market execution because sometimes you can catch a deeper put in here. You can, go 50% of this move. How do you know what 50% is? You just go from, here to here with the GAN box, and you can see, look, okay, so 50% would be right in there for that entry. Now, sometimes you might not get triggered in, or you do market execution and just know that price can come back in. Most of the times I will just be okay. As soon as it taps in a little bit into this box, I'm buying, okay, with your stops below here. Now, how do you know where to set your take profit? Okay, that's when we go back to our step 1, which was we're going to look for targets of equal highs. Well, I can't find that text, but we're going to be looking for equal highs on above, relative equal highs, or fair value gaps. I like to go up to the 15-minute. Like I said, you're going to be going back and forth, okay? So here you have relatively equal highs here. There. Okay. Now you also have a gap here. And then you also have relatively equal highs up here. All right. So this is all areas of liquidity for it to target to. Now you can set it to the overall high up here for 576 points. Let's see, do we see anything else here to the left? Yeah, we have some clean, suspect clean. These are almost too clean up here. They also have highs up there, liquidity up there. Now, ICT talks about low-hanging fruit, right? You just want to become consistent. You don't need the whole pie, just small pieces of the pie over time, and you will be consistently profitable and be able to start to learn how to stack and scalp your positions, right? So that being said, whatever size position you put on here, these areas of liquidity above are areas that you can take partials, go break even, or take your whole position, right? So our risk to reward is 1 to 3 here. And we can know we can take partials here or go break even, or take partials here, or take the whole thing here, right? So drop down to the 5-minute and see how price plays out here. There you are. You're tapped in on the very next candle. And if you don't get in there, you have a chance there, right? Price taps in there as well. Taps in there. Like you said, you have to be able to be okay for price to come all the way back into this gap, okay? Now, what's crazy is, let's see if this lines up here, like we said. Now, that was right at 9:30 open, over 9:30 CME open. Was this candle tapped right into your entry? Now, remember we said 50%? You have this GAN box, right? Run high. Where did it tap into? Just under 50% of this whole move. Now, you can do body to body to get more of the chunk of the move and the volume. It gets you closer here, or even 50% of the gap, right? You can do 50% of this gap. Will also get you a better RR in there, or 50% of both gaps, but you would not be triggered in there. Okay. So, like I said, usually I'm okay with just getting in right there at the top of the box, putting my risk below, and then, you know, we're in there. Now, these are different take profits with the overall take profit there. Okay, we'll move price forward, and price just catapults right from that box. What do you know? Shocking, right? And we just have a price being a magnet all the way up. It just runs, right? Like a magnet straight to these areas of liquidity. Have a small pullback, right? But ultimately, right before lunch, TP is smashed. Okay. And you would be done right there. 576 points. And now, if you're not happy with 576 points on US 30, man, I'm scared for you, because, you know, that's greed. But this is how, you know, you can catch these concepts day in and day out. These times, these principles, this setup is the same model and happens day in, day out, same time. It's crazy. So, guys, have any questions? Feel free to comment below. Let me know if there's anything I missed or anything you have questions about. Also, feel free to follow me on Instagram at FXAndrewCapital. Give me a follow, shoot me a DM. I do offer one-on-one mentorship. So let me know if you're interested in that. And thank you guys so much for watching. Please hit that like button. It helps me out big time. Hit that subscribe, and that way you know when I drop new videos like this in the future. And thank you guys so much again for watching. Until next time, trade safe.